Hey, what's up, everybody? It is Monday, June 27th. Yeah, almost the end of the quarter. So the market had a failed attempt at a rally today. No follow through from Friday. And I told you this was going to happen in my video on Friday. Because, again, man, very frustrating. We saw another tax-related liquidity drain on Friday. It was a small one, only 1.3 billion. However, 8 of the last 9 days, business days, has seen a net liquidity drain amounting to 117 billion. Very, very frustrating. And now I'm going to say this, that we are on the event horizon. You know what the event horizon is in astrophysics? That's when you approach the point of a black hole where there's the point of no return. You just get right to that point where gravity from the black hole pulls everything in and you cannot escape. Up to that point, there's still a chance to get away. But once you cross that event horizon, that's it. Everything gets sucked in. And by this, let me clarify the analogy. Right now, tax receipts, tax deposits to the federal government are growing faster than the spending. So we're at that event horizon, or we're just there. It might be still a little bit in favor of a positive liquidity flow. I mean, this month we do have a 47 billion deficit. So we're not exactly at the event horizon yet, but we're getting there. And once we hit that event horizon, that's it. It's a general suction of liquidity. And I won't say it doesn't turn around, where there are conditions that can offset this, and I'm going to talk about that in a second. But like I've been telling you every day, like I think this month we're going to start to see positive flows. It's just not happening because the tax flows they're at record levels, and the spending has come down from last year. So we're seeing this phenomenon, and without a positive liquidity flow, you know, you're just not going to get the support you need in the economy. And if you don't get the support you need in the economy, you're not going to get the support you need for the stock market. And the other thing that's kind of disturbing is, you know, today was a Social Security benefits payments day. And, you know, that's usually a big day where you can get like a 37, 38 billion flow, positive flow. And we'll see the numbers tomorrow. But again, didn't do anything for the market. We tried to rally, and then the rally faded out, and we ended up negative. And this now is a pattern that I have noticed, and I have mentioned it to you guys. I said that on these days, typically where you see, you know, big positive liquidity flow days, like Social Security payments days, in the past, we've seen some good market action on the upside because some of that money is deployed. But now, because of, you know, just negative sentiment or because of the tax drain, it's not happening. Now, it could happen maybe tomorrow. I've noticed, I don't know if it's just coincidental, but there seems to be a one-day lag. But we'll see what happens to the market tomorrow. All right, I said there are some things that can offset the event horizon. And I think we are moving towards the event horizon. You know, I hold out some hope because in August, I mean, you got to wait for August, we get a quarterly interest payment. That's going to be like 43 or 45 billion. But that's in August. Like right now, these daily flows, we're right there on that event horizon. But here's what could offset. Two things. The first thing would be an increase in credit creation. Okay, the banks and the creation of credit, loans, leases, that kind of stuff can offset what the government is sucking in, right? Like somebody has to be a net spender. You create the flow from credit, and it allows the economy to continue, you know, with personal consumption and investment. Now, again, I talked about this last week. There's a limit to that because that's not like money with no obligation, like a Social Security check. That's a loan. And yeah, it's great. You get money in your checking account to do what you want with, but at the same time, you have a debt that has to be paid off. And it is also a function, how much can banks lend is a function of credit worthiness. I've been all over this for many videos now. So far, it looks like loan creation and credit expansion could go on. Sorry. So that's number one. But in order for that to happen, or I should say for that to, because it's been happening. I mean, we got loans and leases growing at the fastest rate in, over 2 years. I think like 27 months right now. I just looked at the banking data. By the way, my new issue of MMT Trader is out. If you want a copy of that, go to my website, pitbulleconomics.com. What was I saying? It's a function of credit worthiness, and as I've been saying, the level of household debt service is low, historically speaking. But it could, loan creation could get boosted up to a faster pace. Sorry, dry air, man. If we got faster QT, quantitative tightening by the banks. And, that's something you're going to learn here. Nobody's going to be telling you that. In fact, they'll be telling you the opposite, which is false. Like, oh my God, QT is tightening. The banks won't have money to lend out. No. I mean, we've seen the banks just handing off deposits and reserves to the Fed's reverse repo facility. They don't want this tsunami of reserves. It is just clogging up their balance sheets, and it puts them potentially in jeopardy of violating leverage ratios. So the faster the Fed could get going with QT and start to really bring reserve balances down, it's going to free up space on bank balance sheets for more credit creation. But they're going so slow. As a matter of fact, there's no QT going on right now. Last week, the Fed's balance sheet was up for the 4th week in a row. Now, they're supposed to be in with the QT right now. They added Treasury securities, and they added a whole bunch of MBS, mortgage-backed securities. So, I mean, it's not happening. And reserve balances went down, but that was only because the banks and the money market funds shoveled the reserves off to the reverse repo facility, which hit a record high. So system reserves did not go down. So we need QT to speed up in order for that offsetting factor of bank credit to expand. The other way, which is a terrible way to expand the fiscal, is for the automatic stabilizers to kick in. How's that going to happen? When people lose their jobs. When you get layoffs, they're going to go on unemployment insurance, and that's going to increase the fiscal. That's a terrible way to get an increase in fiscal, but those are the two things right now. We are on the event horizon. It's going to be very hard for the stock market to gain any upside momentum right now. These rallies are going to tend to fail. I still think it's leaned slightly in a positive liquidity flow, but I mean, every day I go to the numbers and it's like drain, drain, drain. So those are the two ways that, this thing could get offset. And I mean, I prefer it if the Fed would hurry up with QT and get it going, but they're really dragging their heels on that. And the other way, unfortunately, it looks like that's what's going to happen. Like, we're going to start to see job losses, and we're going to start to see unemployment benefits going up, and that's again, it's just a terrible way to expand fiscal. I mean, when you have to when you have to trigger those automatic stabilizers, I mean, just really, really bad. So market's in kind of a malaise right now. I still think there's a slight positive leaning to it for without any of these other things happening, but it's going to be sluggish. It's going to be tough until we get some of those things. The other thing is, like, if we see evidence of job loss, and again, that's a terrible way to get a improved financial condition for the market. If we see job loss, it is going to shift interest rate expectations down. You're going to see bonds rally and yields come down, and I think investors will take that as a positive. So that's basically the situation right now. Funny thing is, I talked about this a long time ago. I said the opposite of the automatic stabilizers are these automatic fiscal brakes that happen, you know, if left unattended. In other words, as the economy grows, it generates more tax revenue, and then if the spending is not kept up at the same rate or at a faster pace, then the tax revenues eventually exceed the spending, and you know, that is the automatic fiscal brake that then gets applied. And that's what's happening now. And politically, there's very little that Biden can do, because he's not going to be able to get through any fiscal stimulus in Congress right now, and that wouldn't even be entertained, because it would be attacked immediately as inflationary. Okay, because inflation is still big in people's minds. Anyway, that's it for today, folks. Wish I had better news. See you tomorrow. Bye.